Hello, this is Kevin Prince, and let me say welcome back to our weekly Market Insights webinar. We're so pleased that each week it continues to join us and in this journey through this crisis. And in fact, we also appreciate that each week the audience continues to grow and grow, and that's really based upon you, A, because you're listening, and B, because you're telling people, and C, I think it's really the quality of questions you're sending in to us that really help us build quality content that really relates towards what you're looking for in the marketplace. So I appreciate all of you that took the time and effort to send a question in this week. And for those of you who didn't, you always have next week because we'll be back again at 1 o'clock on Friday. So let's take the next 30 minutes and share some market insights. This focus of this week is on small cap and mid cap investing. I have a special guest again this week. We have with us the S&P Dow Jones Indices, specifically Hamish Preston from the S&P. And in addition, I will highlight that Mark Rays, head of product at BMO GAM, will also join us again this week. Like in previous weeks, I'll just quickly highlight we have some disclaimers. Our disclaimers are effectively highlighting to you that this is not advice for you. This is effectively to provide you some insights to the overall marketplace. Now, I'm going to hand it off to Hamish because in addition to the traditional disclaimers, Hamish, can you quickly give us your additional disclaimer for this specific audience out there?
Sure. Thank you very much, Kevin, and hello, everyone. So just wanted to make clear that S&P Dow Jones Indices, just letting you all know that Mark and Kevin, the other speakers today, are not affiliated with S&P Dow Jones Indices, and we're not providing endorsements as to their opinions, nor the accuracy or reliability of their opinions. And also just want to make you aware, as Kevin just mentioned, this is not advice whatsoever. S&P Dow Jones Indices does not endorse, sponsor, sell, or promote any product based on one of our indices. And so today's purpose and the slides that I will go through are for informational and educational purposes only. So with that disclaimer out.
Sorry, carry on. Let's jump in there because I thought maybe we should just do right off the bat there, Hamish, is let's start off with a little background on the small and the mid caps. And then effectively, if you can do that too, I know you have some good resources on your website. Maybe you can highlight those. And I'm just going to say before you do, for the audience that are participating today, take note of the titles of the two documents down below because you can quickly Google those and you get your own copy of those too. Great to you, Hamish. Give us some insights, some bigger picture insights on the mid and the small cap, please.
Sure, will do. So this slide is really giving you an overview of the S&P Mid Cap 400 and the S&P Small Cap 600, which were launched in 1991 and 1994 respectively, and as the name suggests, they're designed to measure the performance of mid and small cap US equities. Now, combined with the S&P 500, these indices represent over 90% of the US market capitalization. Now, as Kevin just pointed out, at the bottom of this slide are two papers which focus specifically on the mid-cap 400 and the S&P small-cap 600. So the mid-cap paper is called the S&P Mid-Cap 400 Outperformance and Potential Applications, and these are available on spdji.com. Now, the key takeaway from that paper is that although mid-caps have often been an overlooked asset class, mid-caps have actually outperformed large and small caps historically. And this may suggest that mid-caps are uniquely positioned in companies' business cycles in that they've overcome some of the hurdles associated with small caps that may have perhaps more room to grow than their larger cap counterparts. Now, on the other side of the slide, a tale of two small cap benchmarks 10 years later. That paper compares the characteristics and the index construction of the S&P Small Cap 600 with another index designed to represent the small cap US equities. And really the key takeaway there is that on the S&P side, the fact that the S&P Small Cap 600, like the S&P 400 and the 500, the fact that they incorporate an earnings screen, so companies need to have a history of positive earnings to be eligible to be added to the index, that's contributed to a significant positive quality bias in the S&P 600, and that in turn has contributed to its historical outperformance against some alternatives over the last 25 years or so. So as I said, those papers are available on spdji.com. But taking a step back just for a second, when we talk about smaller caps in the US, and this is now on the next slide, when we're talking about smaller US companies, I think what's quite interesting is, in a global perspective, smaller US capitalizations are actually quite large when you take a global perspective. So this chart is showing you the market capitalization in US dollars trillions of the S&P 400 and the S&P 600 against various country components of the S&P Global BMI, which is our global equity benchmark. And what's interesting here is that the S&P 400 is actually of similar size to the Canadian equity market. And similarly, the S&P 600 is comparable size to the Netherlands and India. Now, why do I highlight this? I think this is just useful to keep in mind that the breadth and depth of the US equity market means that if you're trying to explain global equity returns or thinking about things like capacity, for example, it is important to remember that while we are talking about mid and small caps, it's very much in a US context. And in a broader context, there are still some very large companies in these indices. Next up, when we're thinking about smaller companies, an interesting observation that we have made over the last few years and in some of our research is that smaller companies are typically more domestically focused. And what I mean by that is that mid and small cap companies typically gain a greater proportion of their revenues from the US. And so here we're looking at the sales weighted average US revenue exposure for the 500, the 400 and the 600. And clearly we can see that the 600 companies there are typically far more domestically focused. And this may help to explain, I think, why the returns of the S&P 400 and the S&P 600 have been more correlated with US GDP growth, as well as investment and consumption. And so I think this is important because clearly, given yesterday's news and market reaction, people are thinking about US recoveries, as well as what market narratives may come onto the agenda. So recognizing that these unique characteristics behind some of the companies may help to explain why certain market narratives may impact smaller caps more than large caps. And just one more example on that, clearly over the last few years, tariffs and trade tensions have cropped up on several occasions. And one observation, just to bring this home, is that typically when these things have cropped up, the S&P 400 and the S&P 600 have been more insulated than the S&P 500, which I think can be explained by the fact that large cap companies are more internationally focused and therefore are more sensitive or have been more sensitive to narratives. Now, the next section, or the next slide, focuses on the returns side of the ledger. So here we're looking at the cumulative total returns to the S&P 500, the 400 and 600 since the end of 1994. Now, I'm sure most of us have heard of the small size premium, and this definitely crops up. And we can see this in that the S&P small cap 600 outperformed the S&P 500. So the yellow line is higher than the dark blue line. And as I mentioned earlier, if you look at the returns of the S&P small cap 600, they have a strong relationship with the quality factor. And because the S&P 600 has outperformed alternative measures of US small cap equities, that in turn has made the S&P 600 a harder benchmark for active managers to beat historically. And for more information on that, I would encourage you to look at our SPIVA scorecards. But what's also interesting about this slide is that the S&P Midcap 400 outperformed both the 600 and the 500. So that light blue line right at the top there outperformed the yellow and the dark blue line. And once again, this goes back to the fact that many mid-cap companies may be well positioned in their business cycles to have more growth than perhaps, or growth opportunities than large cap counterparts, while having overcome some of the hurdles associated with small caps. So once again, for more information on that, those two papers that I mentioned right at the start have much more detail on that. And with that, back to you, Kevin.
Thanks for that, Hamish. That's really good insight. And I really actually like that chart you showed on the correlations, because it really does give some, thoughts about, how it participates specifically with the GDP in the U.S. marketplace. That's very insightful. Thanks for sharing that, and thanks for the paper too across the board. Mark, I'm going to actually maybe reach out to you, because I know you've done some work on the composition of the respective indexes out there, and maybe give some context about these investable indexes, because each one of the ones we're showing on the screen are now investable, of course. So, and maybe give some thoughts for those and the risk aspects of them too across the board, because you put the standard deviation there.
Sure. Thanks, Kevin, and thanks everyone for joining us again today. We appreciate your time. I just thought it would be interesting to put these indexes, these products in context relative to the Canadian market, which of course is the market we all know and love. And when you think about our TSX composite, which is the second column in, the total market cap, when you look at that, it's obviously not comparable to the S&P 500, which has your Apples and Amazons of the world, but it's actually reasonably close to the mid cap. So that's an interesting observation when you think about the size and the dynamics of the portfolio that you're investing in. But the one I really wanted to draw attention to actually was the small cap, because the Canadian small cap, it really is quite small, particularly when you compare to the U.S. At about 1/6 of the size. So in doing so, realize there's quite a difference in the exposure that you're getting there, and as well the Canadian market, of course, particularly for small caps, you're getting far more into resource companies. So think, exploration companies, gold companies, things of that nature, junior gold, that of course you don't see in the U.S., where you've got a much more differentiated sector exposure. So if someone's looking for something where, you want maybe higher risk than the market, so you want to go small cap, I think it just ties into the conversation that looking to the U.S. Is definitely a good way to potentially approach that trade. And it does bear through on the risk a little bit when you see the 3-year standard deviation on the Canadian small cap at over 25%, and all the comparable index is quite a bit below that. So that's quite interesting. The PE, I'd kind of ignore at this point, just with what's going on in the markets, and really just focus on the risk and the concentration in the Canadian small cap, to realize that going through the U.S. market is a much more investable, diverse approach. Thanks, Kevin.
Thanks, Mark. And actually, I want to stay with you for a second, because while we have this slide kind of freshed up from last week, the real key thing I wanted to, hopefully, if you can highlight for us, is really around the investability of the assets, given some of the size of some of these companies out there, like FactSet at $284 a share and that kind of stuff, and trying to have a diversified basket of the small or mid cap. And then also, can you talk about the purity of exposures by looking at more of an index approach to the marketplace, and how it stays pure to that style?
Sure. Thanks again, Kevin. Yeah, and as much as an ETF makes sense for a large cap exposure and a smaller index, the more that you get into more names in the index are more difficult to invest. Those benefits of an ETF, which we see here, just become that much more in place. So you get that instant diversification, very cost effective. Of course, you get the pure exposure because you're investing directly into the securities, the transparency because you know exactly what they are. And, it's bought on the exchange as a single ticket. So really it works for, smaller non-institutional sized trades. And just as importantly, currency choice. So you can invest in Canadian dollars. You can invest in Canadian dollars with a currency hedge. or you can invest in US dollars. So .F here implies the hedge, .U the USD. The mid is Z mid, so that makes sense. And the small is Z SML. So, the other thing we put on here is the AUM and the ETFs. Just keep in mind they're both new, so they're growing. They just came out at the beginning of this year. So no concerns there on the size of the ETF, because of course they access the underlying markets. I'll point out that the mid has had more success to date, which makes sense because of the volatility that we've had in March, and now the upswings more recently. I don't think a lot of people have been looking to put on extra risk on the equity side of their book. So the mid cap trade at this point, or this short period of time, has made more sense for portfolios than the small cap. But if we look ahead, there's clearly room for the small cap in portfolios. Thanks, Kevin.
Thanks for that, Mark. And I think it's great to highlight some of the investable aspects of an ETF. And that purity of exposure is also interesting to highlight that, the stocks themselves that are a small cap, as they grow, they move to the mid. And if you're staying in the small, you're still getting that kind of enriched exposure, that little more higher volatile. And the mids, for that matter, as they grow or shrink, you still get that mid part of the marketplace. So it really does stay that pure to that style across the board, as you can now get that through the ETF exposure. What I wouldn't mind doing is maybe touching base a little bit, Hamish, here. One thing you highlighted in your document from last week was concentration, specifically around the S&P, and you kind of showed where the top 5 companies were part of the overall market. Can you give us some little insights about, these parts of the market, small and mid cap, and how concentrated they are?
Sure. So for those of you who didn't tune in last week, so last week I pointed out that the top 5 names by size in the S&P 500 account for around 20% of the index, which, while high in recent history, is still far from an outlier if you look back to the 1970s. Now, what's interesting and what this chart shows is really that the S&P 400 and the S&P 600 are less concentrated. So in particular, this chart, on the x-axis, you've got the proportion of stocks. So the S&P 400 has 400 companies, 500 companies, 600 companies. And then the y-axis is showing you the cumulative total weight of those companies in each index. So what we can see here is that there's a very steep curve on the left-hand side of the S&P 500 curve. And what this suggests, once again, is that you do have a handful of companies that represent a sizable proportion of the S&P 500, but once again, far from an outlier from a historical context. But the fact that the S&P 400 and the S&P 600 curves, that's the orange and the light blue curves, are far flatter, would indicate that the weights of companies in those indices is far more evenly distributed compared to the S&P 500. And so what this means when thinking about explaining returns of these indices, the S&P 400 and the S&P 600 are less reliant on a handful of names compared to their large cap counterpart.
Thanks for that, Hamish. And then, Mark, let's spend a little bit of time talking about why, the certain small cap or why large cap, a mid cap, sorry. But first of all, give us a little bit of the right exposure piece, Canada, US, kind of how that fits in. I think you did a little bit already, but then we'll spend a bit of time on the next slide about why small cap.
Sure. Well, I think this is just a starker demonstration of small cap versus small cap. And you can see by looking at the sector weights, materials at over 30%, so a third of our Canadian small cap index, clearly means you're overexposed to resources, to gold, to mining. And what's interesting is you look down, what's at the bottom of the list? Well, all of a sudden, technology. So, you think about companies that are going to do well coming out of COVID-19, a very low weight there. Communication services, a similar sector, 2.5%. So clearly a biased portfolio. And when you compare it to the S&P small cap, south of the border, look what jumps to the top of the list. Yes, you got industrials, but tech is right up there. So a much more diverse approach. And where are materials? Only 5% of the index. So just a more stark demonstration of the point I was making about the clear differences between the small cap markets north and south of the border. Thanks.
And then give us a little bit of the why of the small cap itself. I mean, some thoughts around that.
Sure. I think I can go pretty quick here because Hamish was speaking to some of this. You get more of that domestic bias, right? So I think that's quite important. If you're investing in the U.S. for the U.S., the small cap are companies that, obviously are more domestically focused. Again, compare that to the Apples of the world, which clearly have, a global footprint and a diversified revenue stream by geography. Hamish also spoke to the quality bias. So I think that's an important thing to reemphasize, but I don't need to go through it. And then just the performance. If you're an investor for the long term, having a weight in small caps certainly makes sense because you do carry a bit more risk, but as an offset to that risk, you've got the potential to get those excess gains because you are essentially leveraged to the marketplace. Thanks, Kevin.
And then let's talk a little bit about the mid cap itself, because you already had mentioned that there's been some flows towards that area. So maybe give some background on why the mid cap in these particular markets and then more of a go forward space across the board.
Yeah, and I think we've talked about this a little bit as well. So I'll go a little quicker. But certainly concentration, you think about the FANG stocks, which have been driving a lot of the returns in the S&P 500. That's not the case in the 400, so you get a little bit more of a diversified return that way. And mid-cap, as Hamish mentioned, actually does carry some outperformance relative to the other two indexes. One great thing that we like to talk about mid-cap is they're kind of in that sweet spot, right? They've come through the challenges of being a small cap. Obviously, they've matured somewhat, but they've still got a lot of growth in front of them to graduate up to the large cap. So really, they combine the best of both worlds, and it's interesting because it's from a Canadian perspective, it's a bit of an underappreciated slice of the market, but in reality, it can be a great allocation within your portfolios. Thanks.
Thanks for that, Mark. You had a quick little summary slide you want to come across about investing across the universe, small, mid, and large. Maybe quickly talk about that too.
Yeah, and I think we've come through this. So I don't think I need to go into the names, so I think we can go to the next one. Thanks.
Well, let me hand it off to Hamish then. Perfect, because Hamish, last week, and I thought it was interesting, you took a look at the Canadian marketplace on the sectors for the broad market, then you brought in some contrast of the sectors that are being delivered by the small cap and the large cap last week. In this case, let's talk about the small and the mid cap and the diversification those bring in.
Sure. So this slide essentially reiterates what Mark just mentioned, in that the sector weights of the Canadian market versus the S&P 400 and the 600, they're different. So the S&P 400 and the S&P 600 have higher weights to things like healthcare, information technology, which once again speaks to the broader global case. I think that more often than not, for information technology exposure, looking to the US is often a necessity for many companies. On the next slide, we'll just repeat this exercise. We're looking within the different market capitalization spectrum in the US. And while it's true that the 400 and the 600 have higher information technology exposure than the Canadian market, compared to the S&P 500, they actually have far more weight in industrials, financials, and real estate. And I think that goes back and helps to explain why the 400 and the 600 are more domestically focused in their revenue.
Thanks for that, Hamish. And I'm going to switch gears now because we had a lot of questions come in this week, and I want to take some time and effort and answer those questions. I'm going to reach out to Mark first because a question came in regards towards, is now the time for an inverse ETF to invest in that? And maybe you can talk about the rebalancing in that aspect in that space to give people a concept of how these work.
Sure. Thanks again, Kevin. So the first thing that people need to realize with an inverse or even a leveraged ETF is that they're very much trading vehicles and not buy and hold vehicles. What do I mean by that? If you get a short-term directional market, so a market is marching up or down in one direction for a few trading days in a row, you'll generally get the returns that you're expecting to see. But when you get a market that's more volatile, that's going up and down over a period of time, that volatility actually erodes the returns, without getting into the math here, of these products. So, you might make the right long-term bet that you thought markets were going to fall, and markets did fall, but the path in getting there might really impact your return if markets are swinging up and down. So realize that the rebalance daily does impact that aspect of it. And when I think of today's markets, are they volatile? They most certainly are. Look at what markets did yesterday when suddenly people got worried about COVID-19 again, and markets came right off. So that type of volatility, directionally for one day, you could certainly take advantage of that. But just realize then, if on the other side of those days the market's moving up, that overall up and down swing is going to impact your return. Thanks.
Good insight there, Mark. I think that helps put context about the other aspects of investing, not just the short, but how the actual products work inside those markets and the rebalancing considerations. Hamish, a great follow-up question from last week, and looking at the S&P conversation we had last week, really want to get some insights about how it's composed, and then how companies are evaluated to put them in, for example, and then effectively the rebalancing them. Can you talk to us about that, please?
Sure. So at a headline level, the S&P 500 is a 500 company index. And what's important to recognize here is that the index is not necessarily simply the largest 500 US companies in an index. The reason for that is that the S&P US Equity Index Committee, which is responsible for managing the index, they use a number of screens and criteria that companies need to meet in order to be eligible to be added to the index. And one of the most notable ones, I think, is the earnings screen. So companies need to have a history of positive earnings in order to be eligible to be added to the index. Now, in light of recent events, you may be wondering, well, the impact or anticipated impact, perhaps by many investors, on companies' earnings of COVID-19, does that automatically mean that we're going to see higher turnover in the S&P 500 moving forwards? The answer is, I don't know. I don't sit on the index committee. But if you look at the S&P US Equity Indices methodology, it outlines that existing members of the S&P 500 do not necessarily need to meet the addition criteria, because the index committee also considers things such as sector representation, turnover, among other things, when considering making changes to the index. And finally, unlike other indices that have, say, set reconstitutional rebalance dates, constituent changes to the S&P 500, like the S&P 400 and the S&P 600, are made on an ongoing as-needed basis. And the US Equity Index Committee meets on a monthly basis and considers things such as upcoming corporate actions that may have an impact on constituents' eligibility for the index. Now, if you look historically, compared to alternative US equity indices, what making changes on an ongoing as-needed basis has resulted in is that the S&P US Equity Index lineup has typically had lower turnover than some alternatives.
Thanks for that, Hamish. Appreciate the insights for that, and great to have a follow-up question from last week's presentation. And actually, Mark, one quick one for you as follow-up. Somebody's looking to see, how do you get the S&P hedged? And I think you can probably answer that pretty quickly.
Yeah. So happy to say that we do, in fact, offer that exact exposure, which is our ZUE ETF. So ZSP will get you the unhedged version. ZUE will get you the hedged version. So if you want to make a currency call on top of investing in the S&P 500, you have the choice between those two ETFs on exactly that. Thanks.
Then, Mark, a couple other questions for you. Still staying the equity theme, are there any ETFs that make sense as more of a safer bet in these times of uncertainty?
Sure, and it depends on your own risk tolerance and what you're trying to accomplish. But if you're trying to stay with an equity exposure and you want to come away from full market exposure, you can think about things like low volatility. So for the U.S. market, that would be our ZLU ETF, where that ETF looks for lower risk equity names. So that's a way to still have full equity exposure, but with lower risk. If you want something that's a little more dynamic, we've recently brought out our ZPay ETF, which is our premium yield that dynamically adjusts its equity exposure over time, depending on markets are rising and falling, and uses both call and put options to generate income within the portfolio. So if you're looking for something that has less equity exposure but still some, ZPay is a great new tool to do just that. Thanks, Kevin.
Thanks, Mark. And I got one more bonus question for you there. This came actually in today, and the team forwarded it on to me, so I thought I'd highlight it. Perspective on mortgage investment corporations for fixed income, and I'd expand that too because of things like the CMHC investable assets, CMHC investment mortgages out there. Maybe you can talk to that briefly too.
Sure. So mortgage investment companies, generally speaking, they're a bit higher risk. They can be for accredited investors, which means you have to have higher investment amounts in them. There might be limited redemption where you might have to invest for a year, or it might have quarterly redeeming features. It's certainly going to give you a higher yield. So there is, of course, risk that goes alongside. The portfolio might be leveraged. And as well, they're generally private mortgages. So it's for underlying companies that are going to, or investors that are going to have obviously more risk. They're not necessarily going directly to the banks, but they're probably equity backed. So they pay a higher interest rate, and that reflects through on a better payout for the mortgage investment companies. What would I compare that to? Well, we just launched ZMBS, which is mortgage-backed security pools here in Canada. The important distinction there is that ours are backed by CMHC, which means they're government guaranteed mortgages. So you don't get that same risk and volatility. You don't obviously get the same yield that you would get with a mortgage investment company, but commensurately the risk is so much lower. And because it's an ETF, trades on the exchange, you can buy and sell all day long, so you have the liquidity that you're looking for. So overall, I'd say a mortgage investment company, certainly for a more sophisticated investor, typically an accredited investor, understand the portfolio, the leverage, what it's investing in, understand the liquidity in terms of redemption rights. But for someone who wants that higher risk and the commensurate higher return, it's an interesting thing to look at. Thanks.
Well, thanks for that, Mark. And I'm going to bring that to a close for this session because we're now pretty much at time. I want to thank both Hamish and Mark for joining us. And I also want to thank you, the listener, and I guess the viewer too, for that matter, for joining us on our journey. We're going to be back next week, Friday, again at 1 o'clock to spend another half an hour diving into the topic of market insights. Next week specifically, we're going to talk about active versus passive, but in the context to help dispel some of the myths around exchange traded funds. So look forward to you joining us next week. Thank you. Have a great weekend.